Clock is ticking on 2021. So if you haven't done so already, it's time to position your portfolio for the new year. Our next guest has 3 investing strategies worthy of your consideration. Michael Arone is the Chief Investment Strategist at State Street Global Advisors and is here with us now. Michael, happy holidays. Always nice to see you. Hit us with your first strategy.
So I think the first thing investors should do is blend quality and value in the core of their equity portfolios. So here's the thing, Brian. In the early days of the stock market recovery during the pandemic, companies that didn't earn any money did just fine. I think it was indiscriminate buying. But interestingly enough, since May of 2021, companies that earn a profit have outperformed those that don't. And in fact, over the last 3 months, companies with healthier balance sheets, more stable earnings, and dividends have outperformed the market by 6.5%. And on the value side, we expect as the economy recovers, rates and inflation drift higher, those value stocks will continue to do well in 2022. If we can just get past the surge, which I expect sometime in the first quarter, we think value is a good place to be as well.
Hey, Michael, it's Julie. Is there a way that people should be trying to analyze which companies will have, I think your point about profitability is really interesting because, as you say, there was that indiscriminate buying earlier in the year. Should people be trying to look for research on which companies are expected to grow that profitability the most? Or is it a focus more on consistent growth rather than the magnitude of growth?
Julie, I think it's the latter. I think it's the consistency of that growth. So one of the ideas that we have is around dividend growers. So for example, the S&P Dividend Aristocrats Index, for example, we think is a good proxy for quality and stable earnings. That index looks at the S&P 1500 and then selects the companies that have been able to grow their dividends for more than 20 years. So what type of company can do that? Well, ones with healthy balance sheets, stable earnings, lots of cash flow, and low debt to equity. So one of the things that's really interesting is that from 2009 to 2011, we saw some similar return patterns. So 2009, we're in the midst of the global financial crisis, stocks doing well. 10, recovery happens, doing well. 2011, S&P was up about 2%, but the Dividend Aristocrats was up about more than 5.5% above the S&P. You could see something similar here, 2020, 21. Next year could be like 2011 was, and it could be a good year for the Aristocrats.
Michael, what stocks won't have a good year next year?
Well, I think if our thesis holds in that inflation will remain elevated and rates will creep higher as the Federal Reserve begins to tighten monetary policy, I think there's 2 categories that will struggle. Long duration growth assets, so that's your classic technology companies, Brian, and then also your defensive sectors of the market, your typical utility staples. Now, interestingly enough, in the last month, at least in ETF flows, we have seen a bit of a shift towards defensives, towards staples, towards healthcare, that type of thing. But our view is that if rates and inflation creep higher as the economy recovers, your defensives and your long duration growth assets will struggle a little bit. Doesn't mean they'll be down or big bear market. Just means that relative to quality and value, they'll probably underperform.
And when you're talking about the dividend growth dividend growers as well that you mentioned, the Dividend Aristocrats, are some of those vulnerable too in a rising rate environment?
They could potentially be. I think the key here is that as long as the economy continues to recover and the Fed goes at a kind of a reasonable pace, we still have negative real yields here in the US. So I do think some of those will offset that. I think the risk to the call is that if the Fed tightens too aggressively and real rates pick up, that could be a risk to some of the dividend payers. However, if, as we expect, the Fed goes at a slow pace, well telegraphed, and we still have kind of negative real yields, income will be important. And we do think that the dividend growers will outperform.
Michael, we've talked to you throughout the year. It's been a very busy, hectic year. It really started with a bang in January with the meme stock frenzy. As a veteran in this market, what is one thing you learned about investing this year and how will you apply it to next year?
Well, I think it all comes down to the earnings. So ultimately, at the end of the day, what drove markets this year was the incredible earnings growth. And so I do think as we think about 2022, some of those risks, So earnings, we all know the great numbers here. S&P 500 up more than 45% year over year earnings per share growth, more than 80% of the companies beating, and by some of the widest margins we've seen in decades. Now, next year, as we pivot, Brian, it is likely that comparables will be tougher. Growth will slow comparably from this year to next year. Perhaps fewer companies will beat, and by a less kind of magnitude, by a smaller amount. Despite all that, earnings growth should continue to be elevated, meaning earnings per share growth for S&P still above 8% on revenue growth of 7%. That should be enough to propel stocks higher, but could be a risk if we do disappoint. So the lesson I learned is that earnings are the primary driver of stock market prices and expectations about those earnings.
Good reminder indeed. Michael Arone, Chief Investment Strategist at State Street Global Advisors. Happy New Year. We'll check you later.